Good morning, and thank you everyone for joining us. It is 11 a.m. and thank you for taking the time today to join us for our update of the next instalment for the Medalist update of 2025. My name is Nathan Roberts, and I'm an investment consultant, investment specialist for Queensland here at Morningstar. I'll be your MC today and look forward to an engaging session with you. Joining me today is Michael Malseed, Head of Portfolio Management, Institutional Portfolio Management at Morningstar, and Matt Wilkinson, Portfolio Manager. Okay, let's jump into today's Medalist update. If anything, so far, 2025 has reminded us that anything can happen in markets, as we've already seen. Volatility remains a consistent theme. Now, it's my pleasure to hand over to Michael Malseed and Matt Wilkinson to explore the drivers behind recent market returns and how the Medalist portfolios are positioned for what's to come for the remainder of 2025. However, firstly, a quick overview of the products before the deep dive.
Thanks, Nathan. My name's Michael Malseed. I head Institutional Portfolio Management. Thanks for joining us. Appreciate there's a mix of attendees on the call, those that are using Medalist currently, so really appreciate your support. And we'll give you a good update on your portfolios. And those of you that may not be using it, may not be as familiar with it, but are interested. So let's take a minute to give you a quick overview of the product. Basically, it brings together the best of everything Morningstar has to offer. So if you think about Morningstar and its manager research ratings, independent, highly regarded, rigorous process used there. So that forms the bedrock of manager selection for the product. It has to be metal rated. So there's a lot of rigor, certainty, sort of trust behind that. And then on the investment management side, we said within Morningstar Investment Management, our specialty is in asset allocation, putting together strategic asset allocation products for different risk profiles. We do that for big institutional clients and superannuation funds. Done that for many years, and also portfolio construction in terms of building really rigorous portfolios that will achieve or look to achieve your objectives over the long term. So bringing those two things together across manager research and investment management is what builds this product. If you look at this table here, up from the bottom, so it builds on the base of our strategic asset allocation. We look to optimize between active managers and passive managers. As Matt shows you the portfolio later on, you can see that in certain asset classes we use more passive than other. That seeks to sort of optimize the fee and the alpha outcome. Manager selection, as I said, built on the core of our Medalist ratings, but also on our portfolio construction capabilities to blend managers in the most effective way to deliver on outcomes and your objectives. Asset allocation, we do take active positions, and Matt will talk a little bit later around what we've done recently, sort of through April with rebalancing, and post that with some tilts we've made in the portfolio just to express our broader asset allocation views to maximise returns. And then in terms of risk management and portfolio construction, as I said, we do this for big institutions. We're leveraging off the same platform across our whole business. So to give you trust that these managed accounts are managed in a very professional and rigorous way, which is very important for you and the way you run your business. And all in all, that will lead to your clients achieving their objectives over the long term. Digging into markets, just in terms of an economic update. So as Nathan said, a lot going on in markets this year, a lot of volatility, probably a lot of noise. So there's been a lot of talk about Trump tariffs, and I don't want to sort of go into that too much because it's been done to death. Other than, I guess, the volatility we've seen in April, peak fear of markets, and then the walk back or delay in tariffs is, it's separating the rhetoric from the reality. And it's very difficult to, I guess, position portfolios for, say, tail risks or, events that are unforecastable. So if you tried to trade on the back of, news flow in the last couple of months, you would have been probably whipsawed quite badly. we approach these situations with a lot of discipline, taking a long-term view, and Matt will show sort of the activity that we took through April in that volatility, taking a very long-term view and rebalancing. If you look at the actual economic data that's coming out, sort of the fundamentals, I mean, the latest prints are for the sort of the first quarter 2025, and they're not necessarily capturing the uncertainty that's in markets currently. But the US, I guess if you think of it pre-tariff, it was ticking along reasonably well. The market was pretty constructive on the outlook for 2025, and then tariffs brought in a whole lot of uncertainty, which saw the sell-off on the market. GDP growth in the first quarter was a bit weaker than sort of anticipated, just because there was that pull forward in import activity in anticipation of the tariffs. So that was a bit of an anomaly there. The other big thing going on in, I guess, US markets at the moment is around the budget deficit, fiscal stimulus, the big beautiful bill that's coming out. So there's probably been a shift from maybe a austerity tilt towards a bit more of a stimulatory tilt, which it's potentially good for markets and corporate earnings net if there's a bit more stimulus. But there's just a lot of uncertainty around the impact of tariffs and, I guess, the pathway forward. We'd say that on balance of probability, probably the likelihood of a middle ground, the probability is increased, and the tail risks that were probably priced into the market in April have diminished somewhat. So in terms of taking a long-term view, we think you don't want to be sort of trading too much to take a view on either side of what direction the market may take in the near term. In terms of China, that's a market that we've liked for some time. That's been a weak market economically since 2020, with their lockdowns were certainly much more severe than the Western world, and also they've had the weakness in the property market. So in terms of the prints of their data, that's continuing to be a little bit soft for them. They have introduced some stimulus, but probably not enough to get the economy really moving. But the markets have performed very strongly, because I guess the valuation differential between China and the US has really been on display. And probably in the last 6 months, China's been one of the best markets in the world from an investment return perspective. So as I sort of move to later, it's good to see, I guess, a broadening out in contributors to global equity returns beyond just the US, because it's been a bit of a one-way story for the last couple of years. Moving to Australia. Australia, again, is ticking along reasonably well. Inflation's come under control. The RBA's moved to a rate cutting cycle, which is positive for the market and economics and the consumer. So given that inflation has come back down, that's constructive for Australia. And we've got plenty of firepower as well in terms of where cash rates are to continue to support the economy through volatility as it may come from, I guess, the global economy. But we're not immune to that global volatility. Australia's what we'd sort of describe as a bit of a high beta market. We've got that leverage to exports. We've got big exposure to commodities, and also, I guess, what happens in China with those commodity exports. So US tariffs are, I guess, destabilizing for Australia. The direct impact will be felt more in certain sectors than others. Certainly, financials are somewhat immune given the domestic banking sector, but things like healthcare and resources and some consumer products that do export to the US will be impacted. So again, uncertainty there. But if we can tread a middle path going forward, we think on the long-term view, the fundamentals for markets and economies are fairly constructive. This is just looking at global equity valuations. The US, the story of the markets, as I said, for the last couple of years has been very US-led, US exceptionalism. The Magnificent Seven, tech has been driving that. That's made global markets in aggregate look expensive. If we split that out, the US is certainly trading at a big premium. Now, there's probably good reasons for that. If the constituents of that market are higher multiple, higher growth businesses, and that can somewhat justify it. But looking under the hood of global markets, you can see there's a lot better value on offer outside of the US, developed markets, Europe, UK, and also emerging markets, which includes China, as I said before. So when looking at headline numbers, you might say that the global economies or the global equity market is expensive, but the way that we look to invest is look for those pockets of opportunities that are better valued and have more diversification. And as I'll talk about in a minute, that's actually was playing out quite well in the first quarter of this year, where we'd seen a broadening of the contributors of the market. Europe, China had outperformed, US had probably underperformed. In this near term, like volatility, we obviously saw the US sell off very heavily, tech sold off heavily, but there's been a very strong sort of V-shaped recovery in the last month or so. So in the last month, we've probably seen a little bit more of concentration of returns coming back into the market. But the broader theme is a broadening in the contributors to global equity markets. The next slide just shows that concentration of global market returns. So the US really has dominated. It's been a decades-long theme. And so that, if you are just looking at a passive exposure to global equities, you're getting 64% exposure to the US, and that's the most expensive market. So when building portfolios, you really need to think about diversifying geographically to really diversify your valuation risk in the portfolio. Looking at this is just price earnings growth ratio. So this shows that in terms of long run averages, because the earnings growth has been reasonable in the market, like the market's expensive, but it's not extremely so, as long as earnings growth continues to hold up, particularly from those big tech names. And if we can see, I guess, improving fundamentals across that broader economy, to see that broadening of the contributors to the market, then that should support the equity market going forward. Notwithstanding risks of tariffs disrupting that, again, could be disruptive to earnings growth. And then in terms of Australia is expensive, sort of on long run basis. If you think about the constituents of the market, half of its financials and resources, CBA's biggest stock in the index, that's trading at all-time highs and sort of one of the most expensive financial services firms in the world. There's reasons for that, but it does mean that if you have a passive exposure to Australia, you are exposed to very expensive parts of the market. So again, Matt will talk about some things we're doing in the portfolio around our Australia exposure and how we want to diversify and how we think about the earnings growth outlook or the market growth outlook for Australia in valuation terms versus the rest of the world. This is just year-to-date returns and really comes back to what I was saying earlier about that broadening in contributors to the market. So this covers over the path that we've had of that big drawdown in April and then the V-shaped recovery. But if you just look at year-to-date, Europe, United Kingdom, emerging markets, including China, have performed very strongly, and value has performed strongly. So that's a big change from where we've come the last couple of years. And US has actually lagged. Now, a lot of that was going into that April downturn and in that first couple of weeks in April. Then in the rebound, it has been a bit more concentrated in terms of growth names bouncing back. So, but we think this broad picture of the broadening of the market is going to be an ongoing theme, just given where valuations are and given where global macroeconomic conditions are. And then this slide just shows sector returns year to date. So the bars are the total return year to date, and then the dots either side of the bar is just the range of outcomes from peak to trough. And this is just to highlight that volatility in the market has been pronounced, and trying to position in any one area for that volatility is going to, as I say, sort of whipsaw you. So when we build portfolios, we're thinking about that long-term, fundamental basis. We're not trying to trade short-term. And if you do that in these sorts of markets, you're more likely to sort of be locking in poorer returns than capitalizing on sort of short-term gains. It's sort of a risky way to play it. So yeah, we're taking a very long-term fundamental view, looking through this noise and volatility to set the portfolio up for the next 3 to 5 years. In terms of portfolio drivers of the market, so this is just the major markets sorted by the total 3-month return, and then the colours show, the dark green's the strongest and the red's the weakest. If I start at point number 1, China, Europe, value, EM over a 3 and 6 month basis. This is this story of that, strong contributors to the market, much stronger than sort of growth and the US. That's pleasing to see. But if we look at point 2 on a 1 month basis, it's actually all been that growth and US market that's rebounded strongly. Elsewhere, bonds have been performing their role in terms of portfolio diversification, which is good. Certainly, yields have had the headroom to be able to provide cushioning to the equity market volatility and weakness. Small caps in Australia has been particularly volatile. Like, we see that as a real a sector that's off benchmark for this product, but an area where we think if we can pick the right manager, they can add a lot of alpha through stock selection, and that's certainly been a feature of the market. It's a big stock dispersion in that market. And then the ASX over the last 3 months in that, particularly in that rebound from the April lows, has been performing very strongly. And that, as I said, Matt will talk about just how we're positioning in that going forward. And then perhaps just on the right, in terms of 1 year returns, very strong across all asset classes. So that's so just thinking about it in a total return perspective, that's been very good for portfolios where we're sitting today. Certainly, in early April, when the markets had fallen off, those numbers didn't look as good, but it's pleasing that the market's recovered to post those strong returns now. Now, I'll hand over to Matt, who is going to talk about the portfolio, how it's performed during sort of April year to date through that volatility, and just also how we've been positioning it through the rebalancing and some active positions.
Cool. Thanks, Mike. So something that we're proud of with these products, and in some ways that we were thinking that the risks were, for markets, leading into this year, that there were risks across markets. The portfolios were positioned very broadly, as Mike sort of alluded to before, and what that enabled us to do is to be in sort of better valued areas of the market through the various managers across both, particularly Australian equities and global equities. And so this is the chart of drawdown for the growth portfolio, for the balanced portfolio from March and April, and then the rebound into May and finishes in May. This is not only for the Medalist portfolio, but also the multi-sector series and the 2 CFS All Active and the CFS Core portfolios. So it's like for like, they're all 50-50 growth defensive portfolios. So going in, these portfolios were underweight growth style and the Mag 7, those mega cap, particularly those mega cap US stocks, underweight the US broadly. And then as the market fell, they were the areas that fell the most. We thought there was the most risk in those areas. So pleasing to see that the portfolios outperformed both the SAA for the Medalist and the multi-sector series portfolios. So they outperformed the benchmark there, but they also outperformed the category average. And that was really pleasing to see the design of the combination of those managers come through and reward investors. So the market has broadened out through this period of time. Again, that's been rewarded through these portfolios. And in actual fact, as we were approaching this, we were slightly overweight fixed interest and interest rate duration So we didn't want as much exposure. And as we move to the return slide and performance slide, and what we're really happy with is certainly the 1 and 2 year numbers across all the portfolio series. I realise there's a lot of portfolios up here and a lot of numbers, but it's important to to put this forward for investors. We're really happy with the annualised numbers over 1 and 2 years. We think on an absolute basis they're strong. The 3 years numbers are there for first choice and multi-sector series. They've held up quite well through a volatile period, which includes the sell-off through 2022. They have a longer return history, slightly longer than the Medalist series. Managers are all performing as we would expect. That's important to understand, and from a portfolio construction perspective, from our view. And returns across all the portfolio suites are definitely showing the benefits of diversification at a manager and a security level, and in particular across asset classes as well. So let's talk portfolio update and how the portfolio is positioned right now. Just taking the Medalist growth portfolio was 70% allocation to growth assets. So by and large, the portfolio is close to its SAA across most of the asset classes. We have taken an overweight. You can see the one blue dot that's sort of sitting above and one sitting below. So we're overweight in global shares, slightly underweight in Australian shares. Now they're quite modest, but they're in line with our views across those asset classes. As Mike mentioned before, he talked about valuations and particularly from a PE perspective across the US and then developed markets and the emerging market equities area. We see, according to that chart, and we also see it in our own research, the US is quite expensive, but these portfolios are overweight. Europe, UK in particular, we do have a slight overweight to emerging markets as well. That is being funded primarily from US equities, but also from Australian shares as well, where we have quite a mild underweight too. Across the other asset classes, we are about benchmark, a little bit overweight in Australian bonds, a little bit underweight in cash, but all the others are very, very close to benchmark. We're also just important to note that we're taking active risk in those equity asset classes, Australian shares and global shares, and using those managers to produce, to expose the portfolios to those alpha opportunities. The last point there on the right is just in those fixed interest asset classes, we are overweight credit and have built up a portfolio duration at benchmark, and we're making sure that we're using some good high conviction active managers in Bentham and Janice Henderson to adjust those portfolio characteristics. So this colourful chart is showing our asset allocation over time. The most recent time period is on the right, starts on the left-hand side. And what we're highlighting here is two specific areas of rebalancing. And I think it goes to the benefits of having a professionally managed portfolio in that we are reacting in real time to movements in the market. And although these two periods are quite close together, and in typical market environments, such rebalances probably wouldn't be as close as they are. But given the movement in the markets, we've sought to make changes and react to those market movements, and we've added value to those portfolios. So the first time we did that was back in April. If you can see the light blue and the green overweight bonds, global bonds and Aussie bonds as we entered the dip. So we were defensively positioned as the markets fell. Essentially, we bought that dip where all those bars shrink right in the middle there. And we increased our growth assets back up to SAA. We actually increased the Aussie dollar hedging because if you recall, the Aussie dollar fell. again, managing the currency exposure is very important in these portfolios. We went slightly overweight Australian equities, which also means we're slightly overweight sort of mid caps, both across Australian equities and global equities, and we were underweight US equities. This worked out well as Australian equities bounced very, very strongly, and as did small caps, particularly in Australia too. Now, as you move to the right for the middle of this bar chart, you can see those positions that were overweight grow even stronger, particularly the purple, which is Australian shares. So that's worked out well. And as the market seems to have sort of, gotten a little bit ahead of itself, we've rebalanced again. We've left that pink on top of the bar there. That's global shares. That's our slightly overweight into global shares. And we're in that dark purple is the slightly underweight into Australian shares. But what we've done is we've gone back to SAA on a growth defensive asset class basis. We were overweight growth as the market had rebounded by around about 2%. So we've curbed that. We're very much conscious of what the benchmark is doing. We want to make sure that these portfolios certainly have one eye on the benchmark. Again, we moved to a mild overweight in global equities and underweight to Australian equities. And we bought back some of those fixed income yields that, a little bit higher than where they currently sit now. So that's been a beneficial trade, particularly as those yields have fallen and bond prices have risen. So I think there's really two good examples of the reason why we have actively rebalanced these portfolios.
Matt, I've just had a great question come through. I might ask whilst we're sort of talking about exposures. What sectors in the UK and Europe do we prefer? And will the diversion of China trade from the US to the euro impact positively or negatively on the UK and euro?
I think on the second one, there is potential for diversion of product to be deflationary, ex-US. So we're concerned about inflation in the US because of tariffs, but with a redirection in global trade, that could be positive for inflation rest of world, including Australia. So that can, give more policy headroom for central banks to ease. So that's potentially good, although there'll be a whole lot of negotiations because Europe's not going to want perhaps competitive industries flooded with goods from China. So there's a little bit to play out there. In terms of sectors we like in Europe from our own sort of fundamental research point of view, we like the areas that have been sort of beaten up the most in terms of concern of tariffs. So consumer luxury goods, things that have got like a really big margin of safety where there's not much positivity in the price, but over a long-term view, looking beyond the sort of the disruption of tariffs, they've got strong competitive positions, strong brands, strong pricing power. So really, the upside is all on the table for you to take the position in it now.
Thanks, Michael.
I'm just conscious of time and just probably briefly touch to this slide. This is the detail, and as the slides will be handed out, I won't talk to it too long. Just on the right-hand side, the key sector and regional positions. Again, we've moved to neutral growth and defensive assets, mildly overweight global equity. We've talked to that. The overweights and underweights in terms of a sector perspective, halfway down down that column on the right-hand side. Overweight Australian and US telecommunication services, as Mike talked to just a moment ago. Overweight European consumer, staples in this case, and healthcare. And also there's a slight overweight to utilities. Underweight the US IT area, underweight financials and Australian banks. That's often exhibited and comes through with Australian fund managers. And then underweight materials and A-REITs as well, mildly too. So probably the key things to talk about on this slide. And just so you understand the portfolios themselves, this is the allocation as of the end of last month. Let's probably pick out just the column furthest to the right in the green. That's the high growth, all growth portfolio. just underweight cash slightly there as markets have moved around. But versus, and the SAA is in the grey on the right-hand side, slightly underweight Australian equities, overweight global, but very diversified across managers and investment styles. This is where this diversification piece is really coming to the fore in the Medalist portfolios, not only through a manager, but also that their investment approach, so that any one investment approach can benefit you through market cycles. More managers in global equities, including using the BlackRock IHVV, which is the S&P 500 ETF, just to manage that US position there. And also we're using Vanguard Emerging Market ETF to get that emerging market exposure. And that's it from our perspective. We're happy to take some questions just as we've ticked over time. If you're feeling you need to drop off, you can. There will be a recording coming out, but we're happy to take some questions.
There is one last question that has come through. Look, GQG has been a very strong performer within the portfolio and across the market over the last couple of years. And it's understood that they have changed their exposure a little bit with the holdings that they now hold compared to more recent history. Does it continue to play its role within the international equity allocation of the portfolios?
Well, GQG's been a very strong performer since its launch in Australia, but since its launch overseas as well, in about 2016. Lead portfolio manager Rajiv Jain has had lots of experience in rotating his portfolios, substantially and dramatically, and often to really good effect. That he did that through 2021 when they were exposed to energy, and when energy really rallied, they were exposed to, and then technology through 2023 and into 24, and they've rotated again now. Now they see the markets as being a little bit risky, and so they've defensively positioned their portfolio and just into areas where they have much higher confidence of earnings coming through, where they don't see this, at the moment they currently see a sort of elevated risks in areas of technology and things that have, outperformed, in the last few years. So we like that they can do that. They offer something different. Again, it's a different investment approach, which we think, overall can contribute something material to these portfolios.
Thanks, Matt. Look, I'd like to thank everyone today for joining us. Thanks to Michael and Matt for your valuable insights into the Medalist portfolios. I think now more than ever, investors having access to recognised, dependable, trusted and professional managed portfolios, as is the Morningstar Medalist solution, will definitely provide investors comfort and true diversification as markets move through the cycles as we've seen. So I thank you again for taking the time to join us today. We value your feedback and keep an eye out for the next invitation for our next webinar in the series in July. Till then, thanks for your time and continued support. If you have any other questions, please reach out to your local Morningstar investments team. Till then, take care.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.